Ladies and gentlemen, boys and girls, friends and family, legends and legendettes from around the entire world. My name is Jeremy Alexander Newsome, and I am joined today by Kim Butler. And she has an incredible speciality. It's a hard word for me to say sometimes. And I'm going to ask her about that so that we can all learn together about more about whole life insurance and specifically how we can use it to optimize our life and just all the cool little tips and tricks that she knows about because she's a professional. For how long, Kim? You've been doing this for what, 2 years, 3 years?
I'm thinking like three with a zero attached.
30 years. I love that. All right. So, an optimal professional, an Olympian, realistically, an Olympian of insurance. One word that you throw around a lot, and I want you to help me with it. You love this word. Starts with a G. Guaranteed.
Yes.
What does that mean from an insurance standpoint, Kim?
Haha. Well, it has a couple different aspects of the word guaranteed as it applies to your emergency opportunity fund. So that's what's called cash value. And cash value in insurance language is just liquid money. It's your emergency opportunity fund. And I never let clients just say emergency fund, right? We all want to be pursuing opportunities. We want our thought to be forward going. We want to be working on things that have potential for us. So the emergency opportunity fund is guaranteed and it's guaranteed to grow. And then there is another aspect of whole life, which is also guaranteed, and that is its death benefit. And this is the part that we don't want to talk about, right? Death is a guaranteed event, but us human beings don't really like to spend much time on it. However, there are a lot of other insurances out there, particularly life insurance out there, where the death benefit is not guaranteed. And I draw a very, very distinct line. Personally choose not to work with them for that reason and others. And so, if death is a guaranteed event, it seems kind of wise that the payment attached with that
Mm,
guaranteed event would be guaranteed. And
mm.
hence my love of the word.
Yeah. How is it different than, let's say, I've heard the term universal life before. I don't really know the difference between those two.
Yeah, I didn't either. I was like 5 years in the industry with my life insurance license helping clients before I really got my arms fully around the difference between whole life insurance and basically all of the other types of insurance that are not term. So, just real quick, term insurance is like renting a house, and your community's super familiar with this. It's just something I was trying to think of a stock relation too, but I'll just go with the analogy I started
Perfect.
with.
Perfect.
Term insurance, like renting a house. Nothing wrong with it. It's awesome. Do it, but understand it's temporary. And then you have these other two landscapes that are called permanent insurance. Unfortunately, the word permanent can truly only be applied to whole life because of the guarantees. The universal life space, universal life, variable universal life, index universal life, ABC and XYZ universal. If they have that word universal in there, sometimes the word is also flexible, which sounds kind of appealing to us human
Yeah.
beings.
Yeah.
Nevertheless, if you're going to have flexibility, you're not going to have guarantees. And so universal life is literally built on a completely different structure. So people want to put whole life and universal together, but it's kind of like apples and beans, not even apples and oranges. Like that's how different universal life is. And you could call it an investment. Some people do. That's probably one of the biggest distinctions that I would make is that it's just in a space that's over there in a different environment. I choose not to work with it because it's not guaranteed. I have an awesome little one pager. So if people are really hungry for a comparison between whole life and universal, I've got a one pager. They can just shoot me a message, and I've got a great little gift for your community at the end. And they can shoot me a message via that link that we're going to give everybody. And you'll probably pop in show notes or wherever. And that will enable anybody that wants to do a deeper dive, get a one-page summary. Plus, I don't know if you're aware, but I have like 8 books on Amazon, and one of them is called Busting the Life Insurance Lies. And it goes deep into
Nice.
this discussion.
There's two reasons I like you. Now there's three. One of them was the fact that you take a relatively boring subject and make it exciting, which is my specialty, in the stock market. That's what I do is, right. I try to educate individuals on the, stocks and make them sound fun and make them be fun. But now the third edition is going to be that you like to use different common sayings, apples and beans. I like to mix up my very frequent sayings as well, because like it does. Like the words we use create the world that we live in, and when you use the same exact sayings over and over and over, it's not a bad thing. It's just you get stuck in those ruts. Thank you for that. I appreciate that.
You're welcome.
A quick question then. What's the number one reason? I'm writing these down. The number one reason people will not use life insurance, in your opinion?
Because our society hates it. Like, I'm not actually sure where such a strong emotion got attached to just a basic financial product that's been around for a couple hundred years, but
Yeah.
literally our society hates it. And it is interesting to watch. You're a YouTuber, you've got a great community. There are definitely starting to be some YouTubers in the space that are lifting the landscape, I guess, of whole life insurance and starting to make it good to talk about. Okay. And then, of course, we had all of 2020 and 21
Yeah.
when death became a little bit more common thing to talk about. So I think that there's some good there, but I will also tell you that it's not a complicated product. And yet there are some YouTubers that are trying to make it a little complicated. And so I think it causes confusion, and us human beings don't like things that are confusing. And so that's another reason why it just isn't out there in use. And I love your verb, because that's really what I teach people to do, is use your life insurance. My very first book was called Live Your Life Insurance, and it is designed to help people understand that term insurance is death insurance. But whole life insurance is designed for your life while you're living, that emergency opportunity fund that I spoke of. And we do not have a better place to store liquidity than cash value of life insurance from a mutual dividend paying company. And it cracks me up. I just saw a big company's publication the other day, and they said, oh, the life insurance space is good. You should buy stocks in life insurance companies. Well, maybe you should. And why don't you just buy the real thing also? Like, buy life insurance from the life insurance companies. But it's evidence that our society does not understand the difference between a public stock life insurance company and a mutual private
Sure.
dividend paying life insurance company.
There's a difference. Yeah, I used to work for a mutual company. It was Nationwide Insurance. That was the mutual company I worked for. Kim, you mentioned the word our society hates it. So when you say our, do you mean like Western society, US society, or just like 2022?
Now, that's a great clarification. I mean North America. So in the US and Canada, whole life insurance as a product exists. And I know you
Okay.
have a worldwide community.
That's right.
And
Yeah.
I am not aware that this product exists, although I have heard it may be in the Orient, but I'm not certain of that. But I know, for example, like Great Britain, they got rid of the product. And I know there are other countries that had it and don't have it anymore. And there are many that have never had it. So it is very specific to US and Canada.
Okay. Okay. I can respect that. Makes sense. So live your life insurance. I'm going to get that book and use it. Those two words I'm going to ask about. When you say use it, how?
Great question. Emergencies and opportunities in that order. So you're going to build up this thing called cash value. That's an asset on your balance sheet. And the first job of that cash value should be your emergency fund. So it could be personal emergencies, business emergencies, family emergencies, all the things that we know in our lives that occur that require money to solve. Emergency fund. And each family's got a different definition of what that is, right?
Sure.
I've heard Oprah
Sure.
Winfrey has like $7 million in her emergency fund. You and I
Let's
might have
go.
100 grand or a million or 10 grand,
Yeah.
whatever the number
Yeah.
is.
Yeah.
Emergencies. The second
Emergencies.
opportunity then is where the real fun lies, is that opportunity fund, the second job of the cash value. and you can borrow against it, also very critical language, which we can get into in a minute, to use for opportunities. And that word is endless. It could be an investment, it could be a business, it could be real estate, it could be all kinds of different things.
Okay. Yes, I definitely learned more about that. And so to give people a little bit of background, I was introduced to Kim Butler through a mutual friend of ours named Christina Wise. Christina has a podcast called the Wealthy podcast. I was on that a few times, and me and Christina became really good friends, and we were working on, I went through her course, she went through my course, right? I'm always learning and trying to understand more financial products. And then I met Kim through one of the podcast panels that I was on. And again, I loved her energy. I'm sure you guys all do as well. If you do, post a comment down below about how awesome Kim is. But specifically, we need to learn more about this because you use the word balance sheet. So what I'm going to do is explain to people watching, there is something out there called a personal financial statement. And if you're looking to buy a house, if you're looking to buy a business, realistically, if you're looking to buy an asset, maybe even a vehicle, you might have to produce a personal financial statement. Your banks and the organization that you're trying to offer money from is going to ask you, hey, are you investable? Do you have money? Do you have income? What Kim just mentioned is that cash value can be listed as an asset under your personal financial statement on your balance sheet. Did I get that right, Kim?
That's correct.
Okay. So you mentioned borrowed against it. Is this the same thing as infinite banking, or am I totally off?
It is. And let's just keep going with the balance sheet. So now you're
Okay.
creating a liability, right? The other side of the balance sheet. And I'll give a numerical example, simple one, but it'll help make it clear very fast.
Okay.
If you have $100,000 of cash value listed as an asset, and you find a real estate opportunity or a business opportunity or some course that you want to take with maybe some marketing expenses, you're going to create some things for your family that's investment oriented or whatever it is, and you borrow against your $100,000 cash value, $60,000, 60. That 60,000 actually comes from the life insurance company against your cash value. Your 100,000 keeps right on growing unaffected by the loan. And this has been in the legal documents of whole life insurance since the beginning of time. Nelson Nash put out a book called The Infinite Banking System, or the actual book is called Becoming Your Own Banker. And it popularized the idea for our current era, even though, like I said, been around forever. And I will admit his book is awesome. And the way he wrote it has some elements that are confusing, which is why I wrote my Live Your Life Insurance book.
Right.
But you were
Yeah.
right on track.
And I think Nelson just passed away.
Yes, he did. About a year and a half ago.
Yeah, there we go. May you rest in peace. But his family is probably very well taken care of because he did this. He did this
Yes.
product. Yeah,
Correct.
He lived this information. So go back to this cash value to go over. I'm writing the notes down. $100,000 cash value. How can you front load that, or do you build it up over time? So let's say I have $1
Great
million.
question. You can front load it, but it's definitely meant to be built up over time. Whole life is designed to use for your whole life. And so typically I like to start people when they're in their 20s and 30s. Now, obviously I start clients when they're in their 40s, 50s, 60s, 70s, even into 80s also, because like an 80-year-old that's healthy has got another 20 years to live. Yet typically you start building over time. You can lump sum, but it's really not designed to do that. There's this whole modified endowment contract limit that hampers that ability. And us human beings need to be saving. We need to be saving, like the verb of putting money away every month or every year, or every quarter, whatever your pace is. And so the life insurance works well for that. So that 100 grand, it might take you 5, 10 years. It could take 2 years. It really depends on your structure, but you build that up. And then again, you borrow against it. And then you pay it back and you borrow against it again, and you pay it back and you borrow against it again. And it literally creates this awesome emergency opportunity fund for the rest of your life.
And correct me if I'm wrong, but I don't think I am. That's not a taxable event. When you pull off, let's say in this example, you have $100,000, you pull off your 60, as you're mentioning, you don't get taxed on that 60.
So here's why I'm so picky about the words, and you'll let me push you on this a little bit.
Yeah, please.
You don't pull it off. That is a taxable event. Aha. Yeah. If you borrow against it,
Good point.
Your community's cheering. She got
Yeah,
Jeremy.
she got
If
him.
you borrow against it, then of course it's tax free because every loan that we get anywhere is tax free. There's
Mm,
nothing magical about that. Your car
mm.
loan is tax free. Your mortgage is tax free. If you have a margin loan, it's tax free. And so, yes, it's tax free because you borrowed against the cash value.
Thank you for correcting that term. And I like that because it's true. Because the keeping in mind, team, that $100,000 of that cash value is still going to grow with with the dividends.
Yes.
What are these, like 1% dividends?
So let's get into that. I love this discussion, and it is a two-part deal. So
Okay.
your cash value grows by the guaranteed rate,
Okay.
which is usually gross around 4%, net
Okay.
around 2 to 3.
Okay.
And if the company pays a dividend, which most mutual companies have paid a dividend every year, well over 100 years, but it is not a guaranteed event. If the company pays the dividend, then that's on top, usually about that
Ah.
one or two that you were referring to.
Mm.
So the total gross growth, in other words, before the death benefit, before the expenses, is going to be in that 6% range, 5 point something.
Yep.
And the net growth is going to be 4.1, 4.2, something like that in today's world, kind of depending on age. And that is after the cost of the death benefit, after any commissions that gets paid, which include also any expenses that the insurance company deals with. So a true, what's called internal rate of return, net, 4% round numbers is the growth of your cash value. And we want to compare that to a savings account, right? This is
Yeah.
not an investment.
No, it's fair. I think that's fair because a lot of people do confuse that too. Because this is treated as such, right? Like you're saving instead of having a quote unquote savings account sitting there in a bank doing essentially absolutely nothing.
Right.
Let this continue to grow at a compounding, and then you can borrow against it whenever you want, and it still grows. So
You got it.
that's cool. Okay, then teach me something, Kim. How is this different than an annuity?
Yeah, a huge difference. So, an annuity is designed to put the money in and stay there until you're 59 and a half.
Okay.
And annuity has different tax law. One's LIFO, one's FIFO. We don't need to go into that. Just understand it's different. And an annuity is designed for an extremely long period of time. Not that whole life isn't also, but whole life gets to get used today. So, literally, if you started a policy within the first year, so maybe not literally today, but within the first year, you get to have access to that. Those annuities, that money is gone. And you often see IRA money moved into annuities for that reason, because IRA money is basically gone money, 59 and a half, right?
Yeah. Are you an advocate or proponent of 401ks, IRAs? You think people should contribute to those?
I do think people should contribute to them up to the match level,
Okay.
MATCH. Whether they go over that or not really depends on their situation.
Yeah.
And I think it's very important, again, to make the distinction. That is an investment. It is also extremely long term because 401ks and IRAs have that same 59 and a half limit that an annuity does. You want to have somewhere else where you're building liquidity. That's the savings account, the cash value account, the emergency opportunity fund. And those two really shouldn't be compared. One's investment, one's savings.
Yeah. Again, I like that. And for if you're fit, if you are listening to this and you don't have a whole life insurance policy, at least check out the links below and give Kim a call. Both my wife and myself have called Kim and had conversations with her, and it was very eye opening. That's the reason why I wanted to have an interview with her, just so that we can all learn more, right? Because this is free for all of you to just learn this information, but at least see if your situation is able to take advantage of this.
Yep. And
Um,
that's what I do all day long, every day.
yeah,
In all 50
yeah,
states, I get on the phone with people and I help them work through their personal financial situation super
yeah,
fast
yeah.
so that then we can say, yes, this fits you. No, it doesn't.
And that's correct. And so it's a yes or a no. The reason I'm bringing that up is because Kim is what I refer to as a good salesperson. There's some people that they're bad in the sense of like they're always pushing the yes, like this is gonna work no matter what. I was like, bro, I don't want that.
Yeah.
So yes, I do appreciate that. Now, earlier I mentioned there's 3 reasons that I liked you a lot. And most people, if you're listening closely, heard me mention 2. Here's the third one. You are a huge Bitcoin fan, as am I. I'm a Bitcoiner, and I'm so happy that you are in this camp. So fun question. Let's say someone's listening. They had a $100,000 cash value of whole life. They borrow $60,000 against it. Can they take that 60 and buy Bitcoin with it?
They can, and a lot of people would say they shouldn't, because there's a whole crossover potentially of a loss for that 60,000. Now, you and I view Bitcoin as a savings vehicle, different than any other crypto out there. And the beauty of a whole life cash value supported loan is you do not have to ask questions. You are borrowing against your money. You do not have to say what you are doing. And so that freedom is there for you 100%. And while you and I look at Bitcoin as a savings vehicle and all the other cryptos as an investment vehicle, we
Yeah.
can both still acknowledge the fact that something could go haywire there.
Sure.
So
Totally.
anytime you're borrowing against something to invest, you want to be uber careful and to have the freedom to borrow against it and do whatever you want with the money is what America was made of, right? Let's have the
That's right.
freedom with our money.
That's right. Yeah. That's why I did that was my freedom dance, by the way, earlier. So what would happen in that situation? Let's just play devil's advocate. Bitcoin goes to 0. Boom. It's
Yeah.
gone. Your 60,000 that you took and you borrowed against your 100.
Mm-hmm. Mm-hmm.
Let's say you don't have the money to pay that back
Yeah.
immediately, but you're continuing. What would happen in that situation?
So ideally, you would make payments on that loan and you would still
Okay.
continue to contribute premium and maybe paid up addition also, which is just some extra money. And you would work to pay that loan, even if it took 10 or 20 years. Now,
Mm,
let's say that you had a windfall, some other investment did awesome. Great. You could pay the loan back lump sum and be done with it. Let's go to the other side, which is you are flat out. You have nothing. You have no, maybe you still have the ability to pay premium, but you have no ability to pay the loan back. You can actually use dividends from the cash value to pay the loan back. You can also go to the insurance company and say, I'm crying uncle here. I really need help. And we can actually reduce the whole policy because, as you remember, there was a $100,000 asset securing that $60,000 loan. So you could just shrink your $100,000 asset to 40 grand and pay off the loan. That should really be last worst case scenario.
yeah.
But there's a bunch of different ways that you can work that. And I've had loans on my own policies sometimes for years and years as I worked through an investments mess, and others go super fast because something worked out better than I thought it was going to. So
I
the
like
whole
that.
world is open.
Tell me about the windfall. Clear me up on that. Something crazy happened to you in the lottery. How do you pay that back? Write a check?
Yes, you write a check for 60,000 and the loan is paid off, and the 100,000 that was with a $60,000 debt is now 100,000 without a
Back.
$60,000 debt. Done.
Got it. Interesting. Interesting. So wait a minute, Kim. You said an investment mess. You've had a mess too? You failed on something
Yes.
before?
I heard the greatest quote this morning from a client who
Tell
said,
me.
if you haven't had a bad investment, you haven't done enough investing. Isn't that
Ooh, I
great?
like that. I
We're all
like that.
learning.
I have a business partner. When we were first connecting, she told me, if you haven't lost everything, I won't work with you.
Mm.
I was like,
Ooh,
okay,
yeah.
that's cool. Yeah, because
Yeah.
she's done that. She was at rock bottom. I was like, well, fun fact, strap in.
Yep.
um, but I can see why, because again, you need to, at some point when you're an investor or when you're in a career of financial aptitude, you should be able to know, can someone I'm working with, or can I, or can whoever, can I trust them with a decision? What was a decision that a failure or a loss, and what did you learn from it? Tell us a little about that story.
I love it. Yeah. So I have a real estate mess that was unbelievable. It included a time when the tenants were questionable, and I was at an apartment building and the police showed up with the guns and the vests and the whole bit and had to go do what they do. And I'm like literally hiding in my car.
Wow.
That was not a good property. You know, we learn things though. My husband
Yeah.
and I learned that maybe this is not the right thing for us, because truly there's probably no such thing as an actual bad investment. There's probably just a bad match, right? Because somebody else bought that apartment building from us and was able to do fine with it. So, you know, you could say it was timing, and that's fine as well. I've had probably 3 or 4 others, and I think the biggest lesson is that connection, that match. That is the investment right for me? Might be right for my friend, might be right for my CPA, might be right for my broker, might be right for my uncle, but is it right for me? Is it a good match for who I am, for what I care about, for the type of life that I want to live? Am I okay with the roller coaster ride or not? Does the investment cash flow, or is it more of a net worth play? Those are questions I always like to look at. I don't think people think about investments that way, but I think they should. And so those are the learnings that have occurred in my life around this space.
I like that. I've begun to build a checklist for companies that I'll invest in or ideas that I'll pursue for that reason. So I can kind of start narrowing down the match and figure out exactly what I want. So if I'm hearing you right, you have whole life insurance, Bitcoin, real estate, any other investment, business, anything else?
Business. That's it.
I like it. I like it. Okay,
Simple,
cool.
simple,
Yeah.
simple.
So, and because those are things that you understand. So, how did you
Yep.
get involved in the whole life insurance thing?
So I got out of college, went to work for a bank, and this was before banks had anything other than checking and savings accounts. This was in the late 80s. And I loved my time there, but very quickly realized I needed to be in a more entrepreneurial environment because I'm not a great rule follower. And upstairs in the bank building was an insurance company that worked with whole life insurance. And I didn't know the distinction at the time. And I also had a father in law that was a stockbroker. So I was aware of those two aspects of personal finance beyond what I was doing at the bank. And I was very interested in that. I found out about the certified financial planner designation and I worked through that. Started working in the space of helping people with their personal finance. And it was everything, you know, it was kind of like starting any business. You'll help anybody in any way because you really don't know what you're super, super good at.
Sure.
After about 5 years, I had kind of a crisis of confidence. And I've written about this in a couple of my books because I was doing financial plans. Now, this is pre-internet. I was doing financial plans for people and I was handing them these documents full of a bunch of assumptions, assuming interest rates, assuming tax rates, assuming inflation rates, assuming ages, et cetera, et cetera. And I would get horrible pits in my stomach because I knew that I had been in the computer room fussing with the numbers to make the quote plan work out. And
Mm.
so I ditched my CFP designation and I narrowed down to the guarantees. And I just got really clear on what I could get super comfortable with that I absolutely positively knew was going to work. And in the middle of all that time, I'd gone through both a real estate crash and a stock market crash. So those teach you a lot of things, as you know. And I just got clear that for me, it was about guarantees. And so I continued to work forward in my life. I developed the 7 principles of prosperity, which are available to everybody on the link that I'm going to give to your community today. And that was in the late 90s, like right as the internet was coming on to play. I developed those 7 principles of prosperity. I didn't make them up. I just took what was basic economic concepts and I applied it to personal finance. And so I wrote those. I've worked with them ever since. They've never changed, which I think is kind of cool. And it enables me to help people. And then, of course, when the internet did come onto the scene, Robert Kiyosaki showed up around that same time. And many people remember his Rich Dad, Poor Dad book. And again, you know, this is just as the internet's existing. So he would go to speak across the country, and he and his wife, Kim, happened to have the same name, worked with us and enjoyed our work. And you'll always hear me talk about we and us because I've always had a team and I'm always grateful for the team. And that helped us take advantage of the internet and really blast our practice to nationwide very quickly. And he does great work. We don't stay in touch anymore, but it's wonderful to see how similar those two empires, if you want to call it, have grown and how we're able to help people. And it's given me a lot of views of personal finance, literally all across this country. And I have a very, very diverse clientele. I can literally be on one appointment at 10 in the morning talking to a 22-year-old kid that can save $200 a month and have my 11 o'clock meeting be somebody worth 20 million and XYZ and everywhere in between. And I love it.
That's incredible. Tell me about this 22-year-old in the sense of, let's say that they happen to watch this video, which is unlikely, but you're 22-ish and you're watching this video. What would your suggestions be? And what tips did you give that person? Let's say 3 financial wealth tips.
Yep, totally got it. So first, identify the amount you can save per month. And you just came out of college or a work program, right? Like you've got this job, try to go for 20% of your income. You're used to living on peanut butter and jelly. So keep that lifestyle for a little while, save the money, right? So let's say that you can save, I'm going to use $1,000 because it's easy math. Let's say that you can save $1,000 a month. Take a good third of that and go all in for the guarantees, the boring. Start with a savings account if you don't want to learn about whole life yet. And build that emergency opportunity fund up. And notice the order that I do these 3 things because it is so critical to have emergency opportunity money. You don't want to have to rely on a credit card if things go wrong. Build that emergency money up. Then I would take the next third, give or take, and do some fun investing with it. It could be a program like you offer, Jerremy. It could be Bitcoin or something in the crypto space. It could be your 401k plan at work or 403b. Be super careful in that space though, because that money's 59 and a half. 22 to 59 and a half is a long time. And then take that other third and start to work to buy a home. So you're going to need to build up a down payment. It's boring, but you'll want to buy a home as quickly as you can. Yep. And go after those 3 things with a vengeance. Automate them. I have a fun little mnemonic device. Simplify your savings, right? This doesn't need to be super complex. Automate your assets, put everything on automation, and install faith in your finances. And when you use those 3 things that I gave you, there's a lot of substance, which means there can be a lot of faith, and your learning can add that faith so that you're ready to go do what you're good at and let personal finance do its job on its own.
Dang, that's a good tip. I like that. And so here's what's cool. So we have $1,000 a month, which I think is extremely realistic, for 22, 23-year-old. I mean, you're hustling, you're grinding, you got some overtime. You don't have anything else to do. Like work a lot, work 8 hours a week. What are you doing? Saving $1,000 a month, 300 guaranteed save. If you like that, 300 for the house. I love that. And you'll like this, but I actually offer a program for $500, they'll get access to $50,000 of trading capital.
Love
Now,
it.
the key secret to that is they can't lose any more than that $500. So it's not like they're putting in 500 and then they mortgage their house or something. They put in that $500. It's fake money. They have to follow a guideline of rules. And with that guideline, if they can make 10% return within the rules, which are very easy to follow, the $50,000 becomes real. And it's a 75-25 split, 75 to the trader, which could be a 22-year-old, 23-year-old from anywhere in the world. How cool is that?
That is awesome. I love it.
Yeah. And I love your formula. I think that's absolutely rock solid. Okay. So then let's go to the, another demographic, just have fun. 60-year-old white male, has insurance, but through work and retires in 2 years, father of 5, married, has a net worth of around $1 million. Most of that's IRAs in his house. What should he do?
Okay. Same person should focus on savings. And this is so common for that generation. They've done houses and investments. And rarely do they have the decent kind of liquidity, the cash
Mm,
that is necessary for peace of mind for that family. And so I would have them go all in for those couple years that they're going to work in a savings program. And they can put the savings in the bank if that's what's going to meet
sure.
their need. The life insurance can work. It does depend a little bit, and you might want to look at insurance on them or the spouse and maybe on the kids. There's some different literal bodies that can be used for that. And I would ask them to keep working longer than they think, because somebody that's 60 that's healthy is easy got another 40 years to live. And so we just forget the damage that inflation does. And so to have somebody stop working in their 60s is super scary to me. I think people need to realize that mathematically, 87 is the new 65. So in 1930, when the age of 65 was put out as that retirement age, our life expectancy moved forward. Age 65 never moved forward. If we did the math and we moved it forward, it would be age 87. Now, we've got two different people in our family that are in their 80s and still working. They're not super full-time heavy duty, but they're 30 hours a week committed to daily effort, and it does them so much good. So I would also really want that person to keep working, but put a dedicated effort to saving, build up that liquidity, let those other things do their job. Ideally, have some good investments like what you offer that they can have faith in, and let those assets continue to ride while they keep earning an income and build up their liquidity and their savings.
Bam. So when you work with clients, last question, what and how do you define retirement? Because you scared a lot of people. You said 80s. It's a large number. So when they're retired, what are they doing? What's their life like? If you had to paint a picture of retirement, what would it be?
I think they should continue to serve. I think us human beings were put on this earth to serve. There's an actress whose name I can't get. She says, we have two hands, one to feed ourselves, one to feed others. And it doesn't mean
Mm,
literally feed, but to serve others, if you will. And
mm.
that activating lifelong service is a utter important definition of life to me. And it's life that we want to be living. And this concept of retirement, I think it should probably be retired. I know tons and tons of people that still work part-time. Maybe their work is volunteer in its orientation. Maybe they get paid, maybe they don't get paid, and they're serving. And because they're serving, they're healthier, they're happier, they're better socially, emotionally, psychologically, physically, physiologically, like every other LY word that we can think of. Now, if you want to go travel for a year, then go travel for a year and come back and go to work. If you want to take a sabbatical for 6 months and do a study program, then take a sabbatical for 6 months and go do a study program. Take long weekends, take a month break, do whatever you need to do and keep working. That's the definition in my mind.
Love that. And I like when you mentioned the word service. So service gives you purpose. And a lot of people have this image of retiring where, okay, I'm retired and now I watch TV.
How
You could,
boring.
it, boring, right? If you have a boring life, you're going to die.
Yeah.
You have to have growth. You have to have something that you're doing as a human, right? That fulfills you, that pulls you, that excites you to wake up, that gives you motivation to stay strong, to stay healthy. And I love your motivation. I love your focus. And it's been an absolute honor to work with you today and to provide true value and enrichment for all the YouTubers who follow real life trading. So thank you, Kim.
Joy to do.
You are a rock star. Have a great day.